Welcome back to the Deep Dive. Today we are jumping into a really critical one. We're looking at the Q3 2025 earnings call for Bakkt Holdings, ticker BKKT.
Yeah, and our mission here is pretty specific. We need to slice through what was probably one of the most contradictory earnings reports I've seen this quarter.
Contradictory is the right word. Management is on the call basically declaring victory, talking about a huge strategic success.
And yet the stock got absolutely punished. I mean, just hammered. So we have to figure out that conflict. You have this great operational story on one hand, and then this severe market skepticism on the other.
And you see that conflict the second you look at the numbers, just the headline GAAP results. I mean, if you only looked at that, you'd think the company was completely broken.
Totally. The GAAP EPS for Class A shares.
Yeah.
It came in at a loss of $1.15.
$1.15. And Wall Street was looking for what, like a 50-cent loss?
Exactly. Around 50 cents. So
Yeah.
a staggering miss by that metric.
But that's where it gets weird, right? Because if you stop there, you miss the whole story management was trying to tell.
You miss everything because you flip over to the non-GAAP numbers, and the picture just inverts. The implied adjusted EPS was a positive $1.21 share.
Wait, positive. So it swung from a huge loss to a huge gain.
A massive swing. The consensus was bracing for a loss of, somewhere between 47 and 73 cents. So on an operational basis, they beat estimates by almost $2. It's just wild.
That's completely incoherent. So, okay, what about the top line? Did revenue at least back up the positive side of the story?
It did, mostly. Revenue came in at $402.2 million. That's up over 27% year over year, which is solid. Mostly driven by more crypto trading activity.
Okay, so strong growth.
Strong growth, but even here there's a little bit of nuance. Against the general consensus of around $283 million, it was a huge beat. But some of the Refinitiv forecasts were higher, so some desks actually called it a small miss.
So even the good news has a catch. No wonder the market got confused. Okay, let's dig in. The market clearly focused on that GAAP nightmare. Why? What was the culprit behind that reported $23.2 million net loss?
The main driver was, and this is key, it was purely an accounting thing. Totally non-cash.
Okay.
And bizarrely, it was tied to the stock's previous success. The vast majority of that loss, $37.2 million of it, was a non-cash warrant liability mark-to-market charge.
Okay, whoa. That is a mouthful. Break that down for us. What does mark-to-market warrant liability even mean?
Right. So essentially when Bakkt went public through its SPAC, it issued warrants. These are derivatives that let you buy shares later at a set price.
Sure.
Well, under some specific accounting rules, if the company's stock price goes up, the value of that liability on the books, the potential cost to the company for those warrants, also goes up.
So hold on. The stock rallied before earnings, a good thing. And because the stock went up, they had to book a massive non-cash charge that destroyed their GAAP earnings.
You got it. That's the trap. It's the classic good news is bad accounting scenario. It's just accounting volatility that completely hides what's actually happening in the business.
So if you strip out that noise, what does the real business look like?
It looks staggering. Adjusted EBITDA, and that's good proxy for cash flow. It hit a positive $28.7 million.
Positive.
Positive. And that's a 241% swing from a loss of over $20 million in the same quarter last year. That is the clearest signal you can get that the core digital asset business is now profitable.
That is a fundamental shift for the company, which begs the question, why didn't management prepare the street for this? I mean, if you have this amazing operational story, but a big, ugly JAP number is coming, you have to manage that expectation. The surprise seems to be what killed them.
That's a great point, and I think it just speaks to the challenge these ex-SPAC companies have. They did mention it was non-cash, but the market just hates complexity.
Yeah.
What they did communicate really well, though, was their focus on cost discipline.
Okay, so how are they making that profitability repeatable?
Well, they pointed out that non-crypto operating expenses were basically flat, around $26.7 million. And even better, if you take out about $5 million in one-time restructuring charges.
So cleaning up the old business.
Exactly. If you take that out, their underlying expenses would have actually declined by more than 18% year over year. Management was adamant, they used the phrase, ending the era of perpetual equity issuance.
Meaning they don't have to keep selling stock to fund the business anymore?
They're cash flow positive in the core business, and they plan to keep it that way.
And the balance sheet reflects that now too, right? They've been simplifying things.
A huge signal of maturity. They ended the quarter completely debt-free. They redeemed their convertible debenture, and they collapsed that old Up-C structure into just a single share class.
Let's pause on that Up-C thing. I know it's technical, but why is that so important for investors?
Well, that Up-C or umbrella partnership C corporation. It's a legacy structure from a lot of SPACs.
Yeah.
And it's just incredibly complex, multiple entities, sometimes dual share classes, crazy tax reporting.
A nightmare for institutions to analyze.
A total nightmare. By collapsing it, Bakkt has made themselves way easier to understand and to invest in. It removes a huge hurdle. They finished the quarter with over $64 million in cash, debt-free, and ready to go.
Which brings us to their new strategy. Management kept saying Q3 was a defining moment, where they refocused the entire company into 3 pillars. What are these new growth engines?
So they're betting everything on this 3-segment model. First up is Bakkt Markets. You can think of this as the foundation. It's all about regulated trading, custody, and liquidity.
And the key word there is regulated.
Absolutely. They have a massive regulatory moat. We're talking 50-state licensing and, critically, the New York BIT license, which is incredibly hard to get. They're positioning this as purely institutional-grade stuff.
Selling trust and compliance.
Yeah.
In the crypto world, that's gold.
Okay, so pillar number 2 is where the growth is supposed to come from, right? Bakkt Agent.
Yes, Bakkt Agent is the programmable finance layer. They're focused on AI, stablecoins, and especially cross-border payments. I mean, they're explicitly targeting the $850 billion global remittance market. That's a huge target. So what's their angle? How do they compete in that space?
They made a really important distinction. They are the picks and shovels infrastructure layer.
Meaning what exactly? They're not trying to be the next Venmo or Cash App.
Exactly. They're avoiding that expensive cash burn of trying to get millions of individual consumers to download an app.
Yeah.
You know, what Visa and MasterCard do. Instead, their whole strategy is about distribution-led partnerships.
Ah, so they build the plumbing, the regulated rails,
Right.
and then they partner with a huge bank or a fintech company that already has millions of customers.
You got it. That lowers their customer acquisition cost to basically zero. They're competing with other infrastructure players like a Zero Hash, but they argue their regulatory standing, especially that BIT license, gives them a big edge in the US.
Smart, scalable, high-margin revenue without the marketing headache. And the third engine, Bakkt Global.
That's their international play. And they're doing it through a minority stake, joint venture, or JV model. They've already locked in a JV in Japan, and they're looking at places like Korea and India next.
So that gives them recurring licensing and management fees without having to put up a ton of their own capital.
That's the idea. But there's another interesting little angle to it.
Oh, yeah?
Management pointed out that this structure could actually give shareholders some look-through exposure to Bitcoin.
How does that work?
Well, Boki provides the regulated custody for these JVs. And a lot of these international partners are adopting treasury strategies where they hold digital assets, like Bitcoin. So as their infrastructure provider, Boki, your shareholders, get this sort of indirect benefit from the success of those JVs.
That's clever. Okay, so you have this really logical, compelling story. Debt-free, lean operations, 3 clear growth pillars, and yet the stock still had that brutal reversal. What was the market's problem?
It's the classic show me story. The market hears the vision, they see the good adjusted number, but they are just not willing to look past that messy GAAP accounting until they see proof of scale. The volatility was just intense. I mean, the stock was up over 6% in the pre-market, hitting $25.
And then the call happens, the GAAP numbers hit the screen.
And it just triggered this cascade of selling. It reversed the full 17 percentage points to close down over 11%.
And the volume was huge, right? Almost 4 times the average. That tells you it was institutions repositioning, getting spooked by the complexity.
Exactly. So now it's all about winning back that confidence.
So what are the catalysts? What are we watching for?
Well, on the macro level, they're really excited about some regulatory tailwinds. They specifically mentioned the Genius Act that's already passed and the Clarity Act that's anticipated.
How do those help Bakkt specifically?
The Genius Act is all about stablecoins. It creates clear rules, which dramatically lowers the risk for their big institutional partners to use Bakkt's stablecoin infrastructure. That's huge for the Bakkt Agent business. And the Clarity Act is focused on tokenizing real-world assets. If that passes, you're going to see this explosion in demand for the kind of compliant custody and settlement that Bakkt Markets is built for.
Those are big picture tailwinds, but what about company-specific proof points?
That's the key. They didn't give any formal guidance for 2026, which the market never likes, but they've circled a date on the calendar. The big one is the Q1 2026 Investor Day.
And what are they promising for that day?
That's when they're going to unveil all the detailed KPIs for these 3 new segments. We're talking hard numbers, trading volume, spread capture, stablecoin transaction flow, NAV accretion from the JVs, everything. The immediate goal is just to sign some of those big distribution partners.
So the whole story really just comes down to turning this one messy quarter into something clean and repeatable.
That's it. They sold the story. Now they have to deliver the proof. The market is basically saying, okay, we'll see you in Q1.
All right, let's shift gears. Before we wrap up, it is time for the segment where we have to remind you, very emphatically, this is not financial advice. We are just analyzing the situation. This is a very volatile company.
Oh, it's absolutely high risk, high reward. I mean, the 52-week range on this thing goes from about $6 all the way up to almost 50. Even with this recent 50 or 60% pullback, this stock moves violently.
So with that extreme volatility and this very clear catalyst date circled on the calendar for Q1 2026, what's the outrageous but plausible trade idea you're looking at?
Okay, so the market has clearly priced in all the fear about the messy accounting. But the underlying operational story debt-free, positive EBITDA, great regulatory position, that story is actually very compelling.
So you're saying there's a disconnect?
A big one. The idea is to play that disconnect. I'm thinking a long-dated speculative call option or maybe a bullish call spread that expires shortly after that Q1 2026 Investor Day.
So you're making a leverage bet that the KPI reveal is going to be the all-clear signal for big money to finally come in.
That is the entire rationale. Look, the sophisticated investors, the institutions, they know the GAAP stuff is just noise. They're waiting on two things: clean financials in Q1, and more importantly, proof that Bakkt Agent has actually signed a major distribution partner.
And if they deliver on that?
If they deliver, the high beta nature of this stock means it could just absolutely rip. I mean, it's very likely to resume that speculative run, maybe test the higher end of its range again, back towards that $40 mark. This current dip, which was caused by non-cash accounting, could be the discounted entry point.
It's a high conviction bet that management delivers on their promises.
It is. They've done all the hard foundational work. Now the market just wants to see the receipts.
So what does this all mean for you, the listener? I think the key takeaway here is that Bakkt has successfully pulled off a transformation. They're now a debt-free, simplified digital infrastructure play, and they have real operational momentum. That positive adjusted EBITDA is proof.
But, and it's a huge but, the market is skeptical. That sell-off confirms it. Investors are demanding clean, repeatable GAAP results, and more than anything, scalable proof points. They want to see the names of those distribution partners before they buy into this story.
So the entire investment case really boils down to one single question, doesn't it? Can Bakkt convert this one-time messy quarter into repeatable, high-margin infrastructure revenue as things like stablecoins and tokenization really start to take off in 2026?
That is the multi-million-dollar question you should be mulling over between now and that Q1 Investor Day.
That concludes our deep dive into Bakkt. Keep an eye on those Q4 updates and circle that Q1 2026 date. We will catch you on the next deep dive.